Hi, I want to share with you today on the Warren Buffett Step-by-Step and Investor Workbook by Richard Simmons. It is from a collection of my popular video tutorial that I've done about value investing and how a simple way to calculate intrinsic value. Shall we get started? Let's talk about next I will have is intrinsic value. Now the picture that you see here is like the value. It's unlocked, okay? Of course, you want to find out if the value, okay, let's say this picture that you see here, this little person in here has a lot of value. They are able to help out in certain things, but if you can able to unlock that cage, is able to come out, then is able to perform much better. And that's what it's all about, intrinsic value, to able to calculate the real value, the perceived value of the asset. And that's typically evaluating the company, the cash flows, and other financial indicators. How many of you know what is intrinsic value? In the book by Richard Simmons, a very good book, I highly recommend you get it, which actually look at Buffettology. Now, in this book, Buffett Step-by-Step, Investor Workbook, he actually analyzes and apply the technique of the master investor. So it's one of the first hand workbook who's distilled the practical essence. So what I've done is that I have taken the essence of the book and presented in two very simple slides. So it's a step-by-step how he did for the Berkshire Hathaway principle and how he uses it. So you can actually incorporate it in your own portfolio too. All right. Now the takeaway number 2 to calculate the intrinsic value is looking at earnings. Okay. So earning multiplied by ROE, the sustainable one, divided by the discount rate. Now, what is discount rate? Discount rate is a long-term discount rate. Is what you expect for the rate of return to investor. And typically, if you invest in any company, what is the rate that you want to return back to you? Yeah, so you look back historical earnings about 3 or 4 years back at 11.3 cent, 12.4 cent, 13.6 cent, and then current earnings in terms of the year is 15 cents, the current year earnings. So we are earning 15 cents. So assuming the ROE 10%, which means the return on equity that we want from our profit, from our investment, 10% is sustainable. And then we use the discount rate of 10%. Now, of course, higher return on rate will give you a higher intrinsic value. That's what it says. So you use the discount value of 10% in here. So using that formula, intrinsic value is equal to earnings times ROE divided by discount value square. Okay, discount square. So 15 times 0.1 divided by 0.1 divided by 0.1, that will give you 115 cents. And that will be the intrinsic value of these shares. That's what it says. Means about 1 ringgit 50 cents or $1.50 in here. So if a company is currently earning 15 cents, has an ROE of 10% and the discount rate, that will calculate the intrinsic value of $1.50. That's what it says. There you have it. Now, our way of calculating intrinsic value is being simplified from this investor workbook by Richard Simmons. Of course, if you want to find more, please get the book or find out some detail from the website or check out a local bookstore to have a copy of this book. There is definitely a lot of lessons and important principles you can learn. Or you can contact me at 010-266-9761 to know more. Thank you for watching.